In this video, we're going to take a look at moving averages. Now, many might already have a working method with moving averages, and if you do, that's great. Perhaps you add other indicators to your trading system to help with those moving averages. And then there's also price. What we're going to do now is we're going to actually look at price as a way to filter some of those entries on a moving average trading system. And pretty much you can apply this to just about any other indicator or any other trading system that you might currently use. Now let's begin by just kind of briefly discussing pivot points. I would imagine that the majority of people know what those are, but just in case you don't, we'll just run through those real quick. So let's zoom in a little bit here. And a pivot point would basically be like a swing high or a swing low. Okay, here's a swing low. There's a swing high. Okay, and we know that because, we know this is a swing high because the next candle breaks this low right here. We know this is a swing low because this white candle breaks this high. Okay, so a pivot point is basically where price turns. So this would be a pivot point. This is one here, one right there, one right here. Even though this candle did not break this low, the next one did. So this would be a pivot point here as well. There's one right here, and there's one right here. Okay, so let's go ahead and add a couple moving averages. It really doesn't matter what they are, but I know a lot of traders want to get in the market. They don't want to sit here and wait several hours before having a trade entry. So I found that the majority of people might use like something high, like a 50, as kind of give them a biased direction, but they'll use smaller moving averages to trigger those trades. Now forgive me, I don't use indicators in my own personal trading. I'm a Fibonacci and price trader. But let's go ahead and grab some moving averages. And let's start with just, okay, well, we can stick with this 4. And it's going to be an exponential. And we're going to apply it to the close of each candle. And then we'll grab one more. And let's just double it. We'll go with 8. And let's make this one something darker. Let's go like, well, I want to be able to contrast it with the green. Here, we'll go with this red here. Okay. So the idea here is the smalling moving average is our trigger, or the average that we're going to follow. So anytime it crosses the red, I mean, that's basically how people trade them for the most part, is they look for a moving average cross. So we're going to do the same thing here. Okay. So let's just go back in time a little bit and find a good, decent starting point. All right, so we can actually start anywhere. I'm just trying to look for several different crosses, just for the purpose of being able to actually show what it is that we want to talk about here. So, okay, so typically when a person trades a moving average cross, if it crosses to the upside, they're going to go long. If it crosses to the downside, they're going to go short. So like right here, okay, the green comes up and crosses the red, so you're going to look to go long. And if it crosses to the other side, like it does here, we're going to look to go short. Okay, so crosses to the up, this is when a person would go long. And crosses to the downward side, they look to go short again. So let's look for some that actually would have been a false entry. And we'll just take a look at how price can help filter that. Okay, here's a couple decent examples right in this area. So if you're a person that's trading every single one of those crosses, or even if you have a system to help filter with that, you can still use price to kind of refine that. So if we look at, let's look at this area right here where the green crosses below the red, okay, the 4 below the 8, giving us an indication here to go short. Price does eventually do that, but there's a better spot to actually get in than on this particular candle. So right here we have a cross on this candle here. Actually, let's draw a vertical line to define that candle, okay, to go short. So what you can do with price is take that candle, once that candle has closed, okay, and we have a confirmed moving average cross to the downside, you wait for this candle low to be broken. Oops. Okay, if the next candle breaks this low point, then you have a confirmation to go ahead and go short. So what we're doing is we're actually using the support and the resistance level of the candle on a candle level versus a swing level, even though this is a swing low. So if you're a person that's just trading every single cross, this right here is saying to go short. Okay, it does later, but at this time right here, it goes long. And if you had a stop, say at the high of that candle, you would have gotten stopped out. So the next candle goes long, right? You can see right here, the green crosses above the red, saying, okay, let's go long. But price doesn't do that. It turns around and goes low. So what you want to do is wait for that candle high to be broken, and that does not occur. So let's wait, and let's wait. We don't break a high. We still don't break a high. And then the green right here crosses below the red on the close of this candle, indicating the trade to go short. So once the low of this candle is broken, which it is right here, you now have filtered this trade entry just by simply using price to continue and go short. Okay, so let's look and see if we can find some other options here where price is actually filtered out that way. Okay, here's a couple more decent examples. We can see right here the green crosses above the red, telling the trader to go long, but that high does not get broken by price. It does not break this candle's resistance level. Okay, so now it turns around and it goes short, and we'll just do the same thing again. Okay, the low, the support level for this candle is not broken by price yet. So then it turns around and it ends up going at long. So we would have filtered out entering a bad long trade followed by a bad short trade. Okay, right here, the green crosses above the red, telling the trader to go long. Again, that does not happen. Price does not break that high. And if you follow these down, it continues to not break that high. So if you would have went long here, you would have lost on this particular trade. I mean, of course, it could turn around later and come up, but for the time being, at the time of the entry, it hasn't. So then the green comes below the red on the close of this candle, and now you have a trade going short. So this is just pretty basic stuff with using price. So hopefully you find this video useful, and we'll look to add some more later. Thank you.